Welcome back. A slowing economy, stubborn inflation, high interest rates and rising costs are creating more zombie companies on the ASX. Just this week, the fashion retailer Mosaic Brands fell into administration, appointing FTI Consulting as administrators and KPMG as receivers. Data from KPMG shows that the number of ASX-listed companies in distress has increased 30% over the past 6 months, rising to 122. I caught up with KPMG's head of turnaround and restructuring services, Gayle Dickerson, who's the receiver overseeing Mosaic Brands, a little earlier.
So zombie company is one that has indicated levels of financial distress for at least 3 quarters.
And are they on the way up with where the economy's going in Australia?
Well, actually, zombie companies are up about 30% as compared to the last 6-month report that we've had. And that's not unexpected given the levels of economic pressure and what is going on in the economy.
And where do you get your data from?
So we rolling analyse all listed companies in Australia and offshore. So we combine market data with financial health data as well.
So what, some of these companies are on the ASX, for example?
That's right. We estimate there's about 3.1 billion market cap of companies that we would classify as zombies.
And how are they allowed to continue operating? Just explain that.
They continue to operate. They may not realise that there's an issue. They may be working on a turnaround plan, a restructuring plan, looking for capital, looking for debt. And a number of them are miners. So a number of them are explorers. Again, that depends on the cycle. We've seen a crash in lithium, we've seen a crash in nickel. They are reliant somewhat on the resources market. So within that bucket, there are a variety of different sectors and companies.
Yeah, so I think back in 2020, there was a lot of companies that got COVID support. That all came to an end and it created quite a few zombie businesses. But what's the difference now with why there are so many more zombie businesses than 6 months ago?
I don't think you can really blame the zombies that are there now on COVID. We've kind of come through that period. I think a lot of it is actually due to economic pressure coming through. We've seen that pressure seep up from small business, the significant amount of ATO debt at the small business end, but also seeping up to the mid and larger corporate end as well. So it is a challenging market. We've seen pressure on consumer discretionary spending as well, and also the supply chain and some of the global uncertainty is certainly having pressure on those listed and larger corporates.
Okay, so the mining sector struggling due to falling commodity prices. What about the retail sector? Just this week we saw Mosaic Brands go into administration. How much pressure are retailers under as well?
A significant amount of pressure. We're definitely seeing that pressure on consumer spending. We're coming into Black Friday, we're coming into the peak retail cycle, so that could be make or break for some retailers this year. And look, I think we're all hopeful that it will be a positive time for them, but we know that there is huge cost of living pressures across the economy, and we know that it's going to be a challenging time to eke out that share of wallet.
What about tech stocks and telcos?
Again, they came up highly in terms of zombie companies in our data. A lot of technology companies, they're not even making a profit. It is more challenging to raise capital. So we expect to see some consolidation across that sector.
All right, are there any sectors that are sort of immune to what's going on right now in the economy?
Oh, there's some that have long-term contracts, and even within each of the industries, there are some really resilient, good examples of corporates who have, strong balance sheet, have managed through COVID very well and come out the other end. So, whilst we've highlighted the zombies, there are a lot of good corporates on the ASX. And
then, are there any sectors that might be primed for a tough time over the next sort of 6 months? I know, for example, construction has really struggled for the last couple of years. Is it out of the woods or is it still potentially under threat?
There is some debate about that, but I think based on our analysis and our data also predicts where we think we see financial distress, we expect to see at least another 6 to 12 months of pressure on the construction sector. We're still seeing challenges around profitability, access to labour, and it's seeping through down to the subcontractors. So there will continue to be elevated pressure across the construction sector, even though there is rising housing demand.
Why do you think sectors like manufacturing and property REITs haven't recorded a zombie company in the last 6 months?
Look, sometimes the data is a little bit surprising, and we certainly have seen at the non-listed level pressure in manufacturing. So again, I think it's those that have access to capital markets, those larger manufacturing players are able to come through the challenges of the economic cycle, whereas some of those at the smaller end are facing challenges. And whilst property has been under pressure, and particularly in the office space, for example, we're still seeing it being pretty resilient in Australia, and I think Australia is still seen as a good, strong place for capital.
Say a board sits down and thinks, okay, we're in a bit of trouble here. What can they actually do to address the issues within their business?
The good thing is there are a lot more options now than there were during the GFC. There's still good access to credit. We've got a lot of private credit players coming into the market here. We've got over 1,000 different players, about 250 billion of private credit already in the market, a lot more coming over. There's still opportunity in terms of accessing capital markets. And there's also new legislation that came in a few years ago, which a lot of listed boards are looking at, which is safe harbour. That provides protection to directors whilst they're working out through a turnaround or restructuring solution. So give them some breathing space while they work through these challenges.
And we know the Reserve Bank's probably going to cut interest rates once or twice, maybe 3 times next year. Is that going to help business as well?
Absolutely, and I think a lot of companies have been waiting for that moment. I suspect a lot were hoping that would be this side of Christmas rather than February, but that will provide some relief, albeit it depends on how much time they've got to work through the issues, how much of an impact that will actually have on the bottom line.
Gayle Dickerson, KPMG's Head of Turnaround and Restructuring Services, thanks for your time.
Thank you.